Hi, greetings. It's me, Dr. Paul Gerhardt, and this is the 13th, let me see if I get that right, 13th video in our Human Resource series. And this video is going to talk about recognizing employee contributions with pay. Let's face it, people come to work because they want to get paid. They have to earn a living, and most people have choices. So if you want to maintain a competitive environment for your organization, you got to be able to attract and retain talent. That really is, as human resource professionals, our number one goal, right? Keep employees happy. Happy employees generate revenues because they're keeping customers happy and coming in with the services and products that they provide. So in this video, we're going to talk about incentive pays, employee performance, recognizing individual performance, linking pay to performance. We're going to talk about something called a balanced scorecard, and we're going to evaluate some different incentive programs. And all right, let's get right into it. So right off the bat, let's talk about what incentive pay is. These are forms of pay that are linked to an employee's performance as an individual, group, or organizational member. They are influential because the amount paid is linked to a certain predefined behavior and outcome. And they may be in the form of either a commission or a bonus. So, effective incentive pay has some requirements. Performance measures should be linked to the organization goals. Employees must truly believe that they can meet performance standards. The organization gives employees the resources that they need to meet their goals, and employees value the rewards given, and employees believe the reward is fair, and the pay plan takes into account the employees may ignore any goals that are not rewarded. I can remember working in a grocery industry, and managers had bonuses, and the bonuses seemed like they were virtually impossible. And before you knew it, when people stopped getting the bonuses in the organization just because they were so unattainable, systems didn't align, people became apathetic, and they lost interest. And a lot of people quit their jobs because they weren't happy with the incentive plan that was there, and it really didn't make it worth people's while. JetBlue has a really unique idea. They use their internal social network, and so when a JetBlue employee notices a coworker contributing to the company's success, they can nominate that person for rewards by posting their appreciation on the airline's internal social network, which is kind of a cool deal. I think incentives and recognition really do go a long way. You can motivate employees with incentives. But as I mentioned before, employees must feel that the incentive plan is fair. You've got to give employees a say in allocating incentives, and employees also want interesting work. They like appreciation for their efforts, flexibility, a sense of belonging to the group or organization, and the inner satisfaction of working well and making sure that it gets done. So incentives are done a lot of different ways, and pay for performance is one way to do it. There's piecework rates, standard hour plans, merit pay, individual bonuses, and then sales commission. So let's talk about pay for individual performance. Piecework rate. This is a wage based on the amount an employee produces. You make 10 widgets, we pay you $10. Straightforward work plan. The employer pays the same rate per piece no matter how much the worker produces. And then a differential piece rate. The piece rate depends on the amount produced. So for individual performance, you can do either merit pay or standard hour plan. And a standard hour plan is an incentive plan that pays workers extra for work done in less than a preset standard of time, and that's similar to piecework. And then merit pay is a system of linking pay increases to ratings on performance appraisals. And you can use a merit increase grid so that people can understand how things work. And so there's individual performance rating and then the individual's compa ratio. We'll talk about that. So with this decision to do merit pay, it really is based on two factors: individual performance ratings and an individual's compa ratio, which is pay relative to average pay. And this system gives the biggest pay increases to the best performers and to those whose pay is relatively low for their job. So you do this based on exceeding expectations, meeting expectations, or below expectations. And so the compa ratio is the employee's salary divided by the midpoint of his or her salary rate. So with performance balances, these are usually not rolled into your base pay. The employee must re-earn them each performance period. Sometimes it's a year or a quarter or half a year, or maybe it's a month. It may be a one-time reward, or it may be linked to objective performance measures rather than subjective raises. So when one organization acquires another, it usually wants to retain certain valuable employees in the organization it's buying. It's a stressful experience, right? So organizations involved in an acquisition may pay something called a retention bonus, and that's a one-time incentive paid in exchange for remaining with the company. Top managers, engineers, top performing salespeople, and information technology specialists often get a one-time retention bonus. Something to consider. Sales commissions. We've probably all heard about sales commissions, and that's incentive pay calculated based on a percentage of your sales. And some earn a commission in addition to a salary. So a lot of different companies work things a different way. And then there's a straight commission plan. And some earners are only earning commissions. I heard of a restaurant where people actually pay to work there just because they get such great tips. And the bosses may retain people by allowing them to have commissions. The more things that they sell, in a similar vein, the bigger pay they actually get. So a commission is a performance bonus for production workers, and they're not rolled into the base pay, as I've talked about. The bonuses could be tied to various measures, including quantity of products shipped within a particular period of time. So hard-driving, ambitious, risk-taking salespeople might enjoy potential rewards of a straight commission plan. An organization that wants salespeople to concentrate on listening to customers and building relationships might want to attract a different kind of salesperson by offering more of the pay in the form of a salary. So basing part or all of a salesperson's pay on commissions assumes that the organization wants to attract people with some willingness to take risks. Probably a reasonable assumption about people whose job includes talking to strangers and encouraging them to spend money. So gain sharing is another pay for performance consideration. So it's a group incentive program that measures improvements in productivity and effectiveness and distributes a portion to each employee. It addresses challenges in identifying appropriate performance measures for complex jobs. And it frees employees to determine how to improve their own and their group's individual performance. So Organizations that want employees to focus on efficiency might adopt a gain sharing program. And knowing that they can enjoy a financial benefit from helping the company be more productive, employees supposedly will look for ways to improve and work more efficiently. There are 10 conditions for effective gain sharing to consider. 1, managers must be committed. 2, a need for change or commitment to continuous improvement. 3, management acceptance or encouragement of employees' input. High levels of cooperation and interaction. Employment security. Information sharing on productivity and costs. Goal setting. Commitment of all involved parties to the process of change and improvement. Performance standard calculation that employees understand and consider fair, that's closely related to managerial objectives, and then employees who value working in groups. So sometimes group bonuses can really significantly boost performance, and there are group bonuses or team awards, and both of these incentives have the advantage that they encourage a group or team members to cooperate so that they can achieve their goal. Depending on the reward system, competition among individuals may be replaced by competition among the group. The organization should carefully set the performance goals for these incentives so that the concern for costs or sales does not obscure the other objectives, such as quality, customer service, and ethical behavior. So group bonuses tend to be for smaller work groups, and they reward the members of a group for attaining a specific goal, usually measured in terms of physical output. Team awards are similar to group bonuses, but are more likely to use a broader range of performance measures, cost savings, successful completion of a project, or meeting deadlines. So with group bonuses, group members that meet a sales goal or product development team that meets a deadline or successfully launches a product, they may be rewarded with a bonus for group performance. There is profit sharing, stock options, and employee stock ownership plans, otherwise called ESOPs, ESOPS. So profit sharing is incentive pay, which payments are a percentage of the organization's profits, and they don't become part of the employee's bonus salary. And they encourage employees to think like owners. And evidence is not clear yet whether profit sharing truly helps the organizations perform better. With stock options, this is the right to buy a certain number of share stock at a specific price. Traditionally, stock options have been granted to executives. With ESOPs, employee stock ownership plans, this is an arrangement in which the organization distributes shares of stock to all of its employees by placing it in a trust, the most common form of employee ownership. So let's talk about the balanced scorecard. The balanced scorecard is a combination of performance measures directed towards the company's long and short-term goals, and it's used as a basis for awarding incentive pay. There really are 4 categories of balancing a scorecard, and those include financial, customer, internal, and learning and growth. So this could be any combination of performance measures directed toward the company's long and short-term goals, and it really can be an effective way of awarding employees. So in a balanced scorecard, you've got a base, a target, and then a stretch. And then you have to evaluate each of the performance categories like service, performance, and then be able to consider critical factors like duration, customer satisfaction index from a quarterly survey, operating expenses and cash flow. And so safety could be a success factor, efficiency and effectiveness, and so these have to all be clearly mapped out so that people are very clear on what the base, target, and stretch goals are, and that's how you would calculate how much the incentive is worth. So some processes that make incentives work, you really have to consider communication and employee participation. People must believe that the organization's pay structure is fair. The process by which the organization create and administer incentive pay can help it use incentives to achieve the goal of motivating employees. It is particularly important to communicate with employees whenever you change the plan. Employees tend to feel concerned about the changes. We hate change. Pay is a frequent topic of rumors and assumptions based on incomplete information, partly because pay is so important to employees. And when making any changes, the Human Resource Department should determine the best ways to communicate the reasons for the change. So participation in decisions, employees should understand pay-related decisions and how it can be a part of a general move toward employee empowerment. Employee participation can contribute to the incentive's success. So whenever change happens, it really is important that you involve employees. Communication is always key. It's always related to all successes and failures, right? And so you have to, people really must be communicating that they think the pay is fair. And when employees understand the incentive pay plan's requirements, the plan really is to more likely influence their desire to accomplish the expected behaviors. And it's important when changing the pay plan to make sure that you are communicating that. So there are short-term and long-term incentives, and short-term incentives could be based upon return on investment, year's profits, or other measures related to the organizational goals. It's an actual payment of a bonus, and it may be delayed to gain tax advantages. For long-term incentives, this could include stock options and stock purchase plans. And the rationale is that executives will want to do what is best for the organization because that will cause the value of their stock to grow. So with performance measures for executives, they can use a balanced scorecard. The Securities and Exchange Commission has requirements that the company be very clear about reporting executive compensation levels and the company's performance relative to that of the competitors. And Dodd-Frank Wall Street Reform and Consumer Protection Act requires that public companies report the ratio of median compensation of all of its employees to the CEO's total compensation. So finally, let's talk about ethical issues. Executives need to be honest about their company's performance, even when dishonesty or shading of the truth offers tempting potential for large earnings. And that's considered insider trading. I can remember working for a large corporation, and the executives knew that they made a bad decision, and so they all sold their stock before the next plan came out. And I think I was the only person in America that noticed what they were doing, because I was doing a research thing, and so none of them got caught. But the next financial reporting period, they talked about some bad decisions the company made, and it had substantial losses, so it really dumped the stock into the ground. So you got to be really careful about what it is you do. Ultimately, you have to look out for a win-win for employees. Happy employees who feel like they're in a fair pay situation will want to give their very best. If they don't feel like they're being set up for success, they're going to have one foot out the door and probably aren't giving their very best. So incentives is really important. You must be very considerate and recognize employee contributions with pay. All right, I hope I've given you something of value in this 20-minute value, and more importantly than that, as always, I hope that you have a day, because only you get to choose how you feel about it. I'm Dr.